It is here. The House has released their report on GameStop, so I wanted to go over it briefly. I've not read through all of it, but I've kind of skimmed through what I wanted to look at, which is the potential changes. So it kind of starts on page 108. I'll link the link to this document in my description. And it kind of starts on where I want to start is with the recommendations. So page 108. Moving into 109, this was kind of my first whatever moment, because this is one of the first things you read in the recommendations, and it's just about adopting regulation through I believe this one's about the social media, but the meme stock market event highlights the need for current rules and market frameworks to modernize to address novel issues presented in new technology platforms and the emergence of coordinated market activity by investors using social media. So the SEC will need to consider how to best proceed from an enforcement perspective to protect the market from potential manipulative trading coordinated on social media platforms. In addition, the ability to remain anonymous on platforms such as Reddit while advocating for certain trading strategies may also provide an avenue to engage in manipulative conduct. So you can read that, such anonymity may undermine the ability of market regulators to police manipulative and distortionary practices. So the main issue with this is whatever, man. If retail can really move the market that much, like in anonymity, then the market is in trouble. Because we all know that big money, the whales, are the ones truly moving the market. Are there retail whales? Of course. But for them to lead with this it's kind of whatever. Overall, though, the narrative, I do kind of like the narrative. It does seem one that comes from a sense of protection. Is it going to happen? Is it true? Who knows? The theme that I kind of get from reading this is they're leaning on the SEC a little bit. I think from what I can tell is they're kind of trying to say like SEC needs to take charge in this. We want to give SEC more power is kind of, if you briefly, the vibe that I'm getting. They go on to talk about a lot of gamification stuff that's in the GameStop report. But I kind of just want to touch on the important things that I believe could change or might change. So this one is just more legislation. The meme stock market event exposed certain fragilities in the stock market. On January 28th, Robinhood faced operational and liquidity concerns. The broker-dealer remained wholly reliant on its market makers to execute trades. This goes on to say that they only had 6 avenues of trading. So nearly all the market makers Robinhood routinely routed orders were unable to execute the trades on certain meme stocks. Had all these market makers been able to execute trades, Robinhood would have been unable to execute trades on behalf of its customers. So while Robinhood was connected to only 6 market makers for the equities on January 28th, functionally providing only 6 sellers for the equities, a connection to the public stock exchange would have connected the company to thousands of buyers and sellers from whom to source liquidity. So this kind of goes back to probably the payment for order flow thing, where they were only dealing with 6 market makers because that's who was paying them for their order flow. And so they weren't going into essentially the lit market, from what I understand. They were essentially trading it all off exchange through these broker dealers that was going into likely dark pools or internalized things that we've gone over before. So they're just saying that if they were connected to the public market, they may not have had these issues because there's many more buyers and sellers on the open public market, or there should be. When you're not internalizing them or selling them in block orders on the dark pool, stuff like that affects the stock price. So they should also adopt legislation subjecting broker dealers that make markets. This basically just says that wants to require institutions to maintain written policies and procedures reasonably designed to ensure that their systems have levels of capacity, integrity, resiliency, availability, and security adequate to maintain their operational. Now, the interesting thing about this, it goes on to say Virtue and Wolverine experienced severe operational strain. Those are the 2 largest market makers under Citadel, and were unable to execute trades for wide swaths of securities. Now, this is unreal. During this period, Wolverine had no written policies or procedures in place. So this is one of the world's largest markets makers in the world's largest market, and they don't have written policies and procedures for this kind of inflow, which was kind of wild to me. So several relevant clearing brokers did not have written contingency plans in place, which is just kind of wild. I mean, so they're basically saying that this was a one-off black swan event and that they just weren't prepared for it. So it was kind of like a COVID thing. Like we weren't really prepared for COVID. There was no written plan if there was a pandemic or a outbreak. And so that was kind of, just how we didn't have a plan for COVID. They didn't have a plan for this market reaction to the influx of orders. This goes on, and just a lot of the stuff is repeated from the GameStop report. And this is where I think they're basically trying to give the SEC a little bit more power, saying that they should devise a liquidity rule that either updates or complements its net capital rule and capitalization requirements. FINRA, working with the SEC, should introduce a complementary rules-based framework establishing liquidity management requirements. Basically just saying that they should, right here, introduce enhanced capitalization requirements for the clearing brokers. This goes on. Sorry, I'm just kind of reading through this. You can as well. So this is just like FINRA SEC stuff. I thought I read something interesting about liquidity rules for brokers, but maybe it's later down. I would have think that I highlighted it. Again, you can read through this. The pages I have highlighted, like 108 to the mid 120s or 130s, are all pretty interesting, kind of more so about the rules changes. So this is just the appendix and who is involved in the case. If you watched it online, then you saw all of these names. And then I just wanted to go on, and this is basically saying that the short selling and securities lending, which I believe they touched on transparency rules for this in this document. And it just says that Melvin Capital gave Plotkin. A lot of us know that they were shorting it. This is a pretty, since their inception, it was a pretty known thing that he had been fairly verbal about. So his firm had been shorting GameStop since Melvin's inception 6 years earlier. So to short a company for 6 years, I mean, you can imagine why the short interest was over 100%. They were literally borrowing and borrowing and borrowing and shorting and shorting and shorting. It goes on to talk about some payment for order flow. There's quite a bit in here that has a negative connotation on payment for order flow, which I believe is good. The advocate, who is it, Keller, I believe he's the Better Markets guy, it quotes him a ton on how negative payment for order flow is. And this just says, because payment for order flow protects and furthers these market makers. Yeah, Mr. Keller also argued that the retail investor receives the worst deal, and only by leveling the imbalance and creating a more transparent, accountable, and fair system would retail investors' confidence increase. Basically just saying, our confidence is low. Like if you're a retail investor, the market's rigged. You know that it is against you. Whether you can place orders for free, it does not affect whether or not you're going to be profitable. And they said earlier in this document on Robinhood's design is not to make you a profitable trader, not to educate you. And it's not even to purchase stocks. It is to trade. It is to buy and sell as quick as possible. It's to gamify the system. And I think that was made pretty apparent. And that's what payment for order flow supports. So I believe that is kind of it. Let's see. Okay, so here's some proposed regulation. The drafted legislation is to address many issues highlighted by these market events, specifically the short sale transparency. So this is what I was referring to. So they're just changing the reporting window from 45 days to 10 days. I think this has been out for a little while, but this is definitely, a move in the right direction. And this, again, is giving them a little bit more power, saying that the SEC needs to kind of jump on this. The SEC needs to do some research on what exactly payment for order flow does. Gary Gensler's been fairly outspoken that he believes payment for order flow is hurting retail, that it's not the most fair act, and that potentially an auction dynamic would be better for retail and the market in general, that we would get a more fair price. And then this goes on, the trading isn't a game act. So like I was just speaking, Robinhood has kind of gamified the market a little bit. And I agree with those things. And obviously they kind of have to say some things about retail being able to manipulate the market. But as we all know, the market makers, the large money movers, the whales, and the hedge funds are the ones that can truly move the market. And if you're being front run through payment for order flow, if they can see your orders, then it's going to be very difficult for retail to manipulate the market unless there's mass amounts of buying and mass amounts of selling. So GameStop didn't really react very well to this being released. It pretty much ran up to resistance and then tanked pretty much straight down off of it. So you can see that it's not going too well for GameStop. That's kind of all I have. SPY's running. We did take a trade today. We took off of this bounce here. We played some calls. So market opened. I waited. I saw this dip. I saw this support and this catch on my support line that I had to the upside. And I bought 385 calls, and then I scaled out. I scaled out of some here, got this larger move, and scaled out of the rest in here. So we kind of caught the top today, made some pretty good money. And that was the day that we had. Hopefully this GameStop report, the brief analysis that I did of it was helpful, and I'll post the link. You feel free to read through it. Thanks.